Okay, everyone, let's get right into it. When you hear exit strategy, you might think of it as a backup plan, a plan B for when things go wrong. But in real estate investing, if you think that way, you will lose money. Your exit strategy is not your backup plan. It's the very foundation of every profitable deal you'll ever do. It's the master plan that will dictate how you buy the property, how you hold it, and how you actually get paid. So if you're not starting with the end in mind, you're not investing, you're speculating. So why is this exit plan so crucial so early? Well, it has to be decided before you even shake hands on a purchase price. Think about it. If your plan is to fix and flip a property, your entire negotiation strategy is based on getting the absolute lowest possible price to buy it. Why? Because you understand you'll have to cover all those renovation expenses and carrying expenses and still make a profit. That goal dictates your offer, and without this plan, you're flying blind. Investors without a clear exit get nervous and sell too early, leaving money on the table, or get emotional and hold on to a loser for way too long, hoping it'll turn around. A good exit strategy is like having a financial GPS. It guides you when to buy, when to sell, and keeps you from getting lost. Now, your exit strategy really boils down to one of three main goals. You gotta pick your player. Number one, you have liquidation. It is all about that one big lump sum profit. You are in and you are out, and usually in a direct sale. The good news? Fast capital velocity. You get your money back fast. The bad news? The taxman cometh, and he taketh away a big portion, often at high ordinary income tax rates if you're in and out too fast. Then there's portfolio scaling. This is for the empire builders. Here, the goal isn't a one-time payday. It's to recycle your equity time and time again to buy more and more assets. You use strategies with debt to pull out your cash and reinvest it, creating a compounding effect that increases your portfolio much faster than buying and holding one property. And third, we have capital preservation. This is the long game, trying to avoid or defer taxes as long as possible. You want to keep every single dollar of your investment capital at work for you, so you can reinvest it in bigger, more profitable properties down the line. It's a question of keeping your powder dry. Let's dive into the classic fix and flip. This is the short game, all about flipping capital quickly. Your entire profit margin here lives and dies in two places. One, your ability to negotiate a killer purchase price from a desperate seller. And two, your tight control over every single rehab and holding expense. The process generally works like this. Step one is acquisition, finding those motivated sellers and getting a property well below its market value. Step two is the renovation. Here's where you turn your vision into reality. But you've got to be a dictator when it comes to controlling scope creep, those little upgrades that annihilate your budget. Step three is marketing. You stage the property, have professional photos taken, and list it in a way to make it appealing. And finally, step number four is the sale. The final goal is to finish this entire cycle, from buying to selling, in a time frame of 6 to 18 months. Let's add some reality to this with some numbers. Let's assume we've got a larger home flip with a total investment of $340,000. Where does it all go? Well, first you've got purchase price, let's say $200,000. Then you've got renovations, easily another $100,000. And this is the part most new flippers don't think about. Holding and selling costs. This is a massive $40,000 line item that eats your profit if you're not. That includes sale costs, including agent commissions, which alone can be 5 to 6% of the final sale price. Then you've got staging, professional photography, and advertising. On top of that, you've got monthly holding costs, your mortgage payments, utilities, and insurance while you own the property. That can easily run you $1,000 to $2,000 a month, and every month until you sell. If your timeline gets pushed back, these costs will cut into profit. And now the warning that so many amateur investors ignore. If you do happen to sell that flip within 1 year, the IRS is not going to treat that as a long-term capital gain. No chance. That entire profit is treated as ordinary income. That's right, it's added onto your salary and taxed at your highest marginal rate, up to 37%. Let that sink in. You take all that risk, you're going through a complicated renovation. You're paying all the holding costs, and the government can come in and take a third of your profit. That high tax expense really cuts into the advantage of that fast capital turnover when compared with long-term plans that receive the advantage of the much more attractive long-term capital gains rates, which max out at 20%. So you have to factor this tax hit into your profit projections right up front. Now, about the other side of flipping, selling a stabilized rental. This is when you've held a property for years, rented it out, and now you're trying to cash in on all the appreciation you've accumulated. Here, success has less to do with rehab and more to do with two things: shrewd market timing and adroitly managing tenant relationships. Keep an eye on market indicators first. You're looking for signs you're at a peak. Rents are high, vacancy is low, local employment is strong, and interest rates are favorable. It's selling near the top of a local market cycle that maximizes your return. Then, second, you've got to know tenant rights. You can't just throw them out for a sale. You'll need to review all lease agreements, give them formal notice, get acquainted with the regulations for showings, which generally require 24 hours notice, and get something called an estoppel certificate from them. It's a form where the tenant verifies the terms of their lease and how much rent they owe. So there are no surprises for the new buyer. And third, you should attempt a vacancy strategy. A vacant house draws the largest number of buyers, especially owner-occupants who pay top dollar. To achieve that, you can attempt to negotiate an early lease termination by offering a cash-for-keys arrangement, where you pay the tenant to leave peacefully, or offer to cover their moving costs and part of their new security deposit. Next, we have a no-capital strategy, wholesaling. When you wholesale a property, you aren't selling a property. You are selling the contractual right to purchase the property. You locate a good deal, place it under contract, then sell the contract to another real estate investor for a fee. The wholesaler's profit is called an assignment fee, and it is typically 5% to 10% of the purchase price. So on a $250,000 deal, you can make a $25,000 fee for putting the deal together without you ever needing to get a loan or strike a nail. But here is the giant legal pitfall. You have to be so careful to market your interest in the contract as opposed to the property. Because if you act like you're selling the house, you can be accused of being an unlicensed real estate agent. And you have to, make your purchase agreement assignable with clarity. You do this by putting the magic words and/or assigns in the agreement. If not assignable, then the whole deal gets ugly and much riskier. Okay, now let's discuss one of the most powerful long-term wealth creation methods, the BRRRR method. That stands for buy, rehab, rent, refinance, and then you repeat. This is not a flip. This is a methodical process to harness the appreciation you generate and extract your equity tax-free without ever selling the asset. It is the best of both worlds, the short-term momentum of recycling capital and the long-term security of cash flow. Let's break down the beautiful cycle of BRRRR. Step 1, buy. You buy a distressed property well below its market value, with an eye only on what it might be after rehab. Step 2, rehab. You go in and rehab it, but with a specific purpose, to maximize both the property's appraised value and rentability. Step 3, rent. You stabilize the asset and get good tenants in. This steady cash flow is what allows the whole thing to work. Step 4, refinance. This is the magical step. Now that the property has been fixed up and rented, its value has skyrocketed. You go to a bank and do a cash-out refinance. Because this is a loan, the money you get back is completely tax-free. It's not a sale, so you don't pay capital gains tax at all. This step gets your original investment back. And step 5, repeat. You take that tax-free, recovered capital, and you go do it again on the next one. This is how you build a portfolio at an incredible rate. Let's place this side by side with a flip so you can see the power. Let's say a fix and flip provides a one-time profit of $37,500. Great, but then it's gone. The cash flow stops. That money has to go find a whole new deal, and you have a massive tax bill to pay. Now contrast that with a BRRRR deal. Let's say after refinancing, the property generates a $7,040 cash flow per year for you. That's passive, recurring income, year after year. You still have the asset growing in value behind the scenes. And best of all, You got your initial investment capital back, tax-free, to repeat the process. So the flip provides a bigger single check, but the BRRRR method builds a wealth-generating machine for life. And BRRRR is longer lasting. A flip is completely dependent upon a high sale price at one moment in time. BRRRR success relies on two more stable things: the appraised value for the refinance and the success of the rental income. Even if sale prices decline, if people are still paying rent, your strategy is still working. This refinance maneuver is of such importance it deserves its own spotlight. Strategic debt recycling is an advanced technique for accessing the wealth you've built up in your properties without ever selling them. A cash-out refinance is the key. The proceeds from this loan are debt, not income. That's a critical half-exit strategy. You're extracting your equity, but you're completely avoiding capital gains tax, and you're not invoking the nasty 25% depreciation recapture tax on the sale. Debt recycling takes it a step further. It is the continuous process of pulling out the equity from your high appreciation or paid-off property and reinvesting that money right away into new income-producing investments. This maximizes your returns by turbocharging the growth of your portfolio. Now, if you want maximum tax deferral, you need to know about the 1031 exchange. The tax code, Section 1031, allows you to defer all of the capital gains taxes on the sale of an investment property if you reinvest all of the proceeds in another like-kind investment property. This is the ultimate capital preservation technique, as it allows your money to compound without being sapped by taxes. But it has infamously strict, unbending rules. You have a 45-day rule. You only have 45 calendar days from the date you sell your old property to actually identify in writing the potential replacement properties you want to buy. Then you have the 180-day rule. You must actually close on and take possession of that new property within 180 calendar days of your sale, or by your tax return due date, whichever is sooner. And these periods are absolute, no extensions for weekends or holidays. And you must go through a qualified intermediary. That's a third-party holder who will actually take the money from your sale. You can't touch that money, not even for a second, because if you do, the whole exchange is nullified and you have to pay all the taxes immediately. And on the subject of taxes, we have to talk about depreciation recapture. It comes as a shock to most investors who sell a long-term rental. Every year you own a rental property, you get a tax deduction for depreciation. The idea that the building is slowly deteriorating. It's a great benefit until you sell. When you sell, the IRS performs a clawback. They want some of that tax benefit back. The profit you make on the sale is put into two tiers for tax treatment. The first tier is recapture. Any profit up to the total depreciation you've deducted over the years is taxed as unrecaptured Section 1250 gain at a rate up to 25%. The second tier is capital gains. It's just the appreciation above that depreciation number and your original basis that gets the preferential long-term capital gains rates of 0%, 15%, or 20%. This is why a straight sale can be so tax inefficient to undertake. If you want to be a savvy investor, you must speak the language of numbers. One of the key numbers is the internal rate of return, or IRR. It computes your investment's compound annual growth rate, and it accounts for the time value of money, the principle that $1 today is worth more than $1 tomorrow. But IRR has a lethal flaw. It assumes that all the cash flow you receive during the investment, like rental income, can be reinvested at the same high IRR rate. For an investment with a big quick return, like a flip, this assumption inflates your true long-term wealth-building potential. You won't likely find another home run opportunity that returns the same rate each time every year. That's why most professionals use the modified IRR, or MIRR. This enables you to input an alternative, more realistic reinvestment rate for your interim cash flows. It gives you a much more conservative and realistic picture of how your portfolio will compound over time. Your exit strategy is not carved in stone. It should be adjustable to the market. We're in a high interest rate environment right now. When interest rates are high, affordability decreases and appreciation slows down. In that kind of environment, Trying to liquidate through sale means you could be selling at a depressed value. So what do? You adjust your strategy. You hold on to your properties. Or you use refinancing to take out the equity that you need and ride out a more advantageous selling environment. This is where the BRRRR strategy really shines again because it's not reliant on a sale. And remember, real estate is hyperlocal. National news headlines are irrelevant. You need to have detailed knowledge of your specific city or even neighborhood. What's happening with jobs? What's in the pipeline for construction? Who's moving in? That local knowledge is what allows you to spot the real opportunities and avoid costly mistakes. Let's talk about some expensive and common mistakes. First, missed tax opportunities. Failing to do a cost segregation study when you purchase a property, or failing to use the de minimis safe harbor rule for low-cost purchases can leave thousands of dollars in deductions on the table. 2. Classification errors. If you have a short-term rental and you report the income on the wrong tax schedule, you can lose valuable tax deductions and even have trouble securing financing in the future. And finally, using a generalist tax preparer. This is a big risk. A CPA who isn't a real estate expert can accidentally deduct personal expenses or mess up your depreciation schedule. This will leave you exposed to tens or even hundreds of thousands of dollars of back taxes, penalties, and interest from the IRS. This is not an area where you want to skimp. So let's step back and contrast our main strategies. Fix and flip, 6 to 18 month time frame, high risk, high tax burden, best for rapid capital turnover in hot markets. BRRRR, 12 plus months per cycle, medium risk, low tax burden, best for tax-free equity extraction in markets with consistent rent appreciation. 1031 exchange, 180-day process, low risk, taxes are postponed. The perfect tool for retaining capital when selling a highly appreciated asset. And wholesaling, 30 to 60 days, high legal risk, but requires zero capital and is great for quick profits. And your useful tax cheat sheet. Depreciation recapture is taxed at a top 25% rate upon sale. Long-term capital gains on the leftover profit is a top 20% for high-income earners. But the winner? Cash out refinance proceeds is a beautiful percent zero, completely tax-free because it's a loan. So to send you off, here are your 5 key takeaways. Number 1, liquidation is tax inefficient. Direct sales come with a huge tax drag in the form of ordinary income rates, or that ugly duo of 25% recapture and 20% capital gains. Number 2, refinancing is optimal for growth. The cash-out refi is your best friend for pulling out equity without paying $1 in tax, avoiding that 25% depreciation recapture clawback. Number 3, the 1031 takes planning. It's the best deferral tool available, but the 45-day identification is a logistical nightmare if you're not ready. You have to have your replacement properties lined up prior to even listing your sale. Number 4, match your metrics to your strategy. Doing quick flips, employ MIRR, not IRR, for a realistic snapshot. Doing long-term building, emphasize cash-on-cash return. And number 5, hold through downturns. In high-rate, slow appreciation markets, wait it out. Holding or refinancing is nearly always preferable to selling at a loss. Master your exit, and you will master the game. Thanks, everyone, for watching. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.